Hello, good morning for most of you, afternoon already for some. This is Brittany Button, long-term care insurance specialist for Art Jetter and Company. Today we have Sean Britt with Nationwide joining us. During this session, we will discuss how the Washington Care Funds Act is influencing other states regarding publicly funded long-term care insurance programs. Now, we will be answering questions at the end of the session, so please type your questions in the chat box, and again, we'll get to those at the end. So Sean, let's get started.
All right, thank you, Brittany, and thank you everybody for joining us today. I hope at the end of the presentation, you're going to understand more about what's going on in other states and where your sales opportunities are. As Brittany said, we will be answering questions at the end of the program, so please type them in as you think about them so that you don't forget what you were going to ask. And if it gets answered along the way, Brittany's going to be vetting them anyway, so don't worry about that. Just type them in as we go. And Brittany, if you see a question come up that you feel it would be best for me to answer now, we don't have, like, we've got a small enough group. I'm comfortable with you interrupting me when I take a breath and just go ahead and ask it. We're fine with that.
All right, will do, Sean.
Okay, this is our agenda, and I'm not going to go through it, but as you can see, we do have quite a lot to talk about today. Get my button to work. There we go. Now, people are always asking me why states are doing this. And the answer is the states doing this have a problem with their Medicaid budgets. In fact, the #1 use in these states for Medicaid is long-term care. Their budgets are stretched to the limit. They're really afraid of the budgets going broke. And so they want to be able to find a different way to delay the use of the Medicaid budget to pay for long-term care services. So the state goals in general, and I mean in general because one state may have slightly different goals than another, but one is to provide the middle class, and we're talking more about the working class. You know, the middle class is a very large range of people, from working class to mid-middle class to upper middle class. So we're talking more about the working class folks who would have a hard time affording coverage. You know, maybe they could buy a small traditional policy, but they may not be comfortable with that because they're afraid of price increases. So they want to provide something for the working middle class. And then they want to preserve Medicaid resources by delaying the use of Medicaid for those who would qualify. Not everybody qualifies for Medicaid, but for those who do, they would like a first step for paying for long-term care. And excuse me, in most states, they're focusing on inexpensive home care, not facility. I'm not going to go through this slide. You can kind of look at it as I talk. What we're really finding out is the private industry is never going to be a sole solution, but nor is the public industry the public endeavors like these state mandated programs are not the sole solution either. And the reason is actually the same 3 reasons: affordability, insurability, and responsibility. On the private side, you have to be in a higher wealth class to afford the policies. The middle class could potentially buy traditional, we're talking working middle class again, but to get those policies that are a little juicier and are have more guarantees, you might have to be more affluent. Insurability in the private market, you have to be insurable. You may have the opportunity for simplified underwriting with some products, but others are fully underwritten, but you have to be insurable. And then there's the responsibility issue. A small percentage, even if they can afford it, is actually going to buy it because they're either in denial that they're going to need it, or they procrastinate in buying it to the point where maybe they're no longer insurable, or one of the persons in the couple are uninsurable, or they have this "I'm going to self-insure" mentality. From a public aspect, how high of a tax is acceptable that becomes a problem. The leverage is not as good as private insurance. And so some people pay more in tax than they'll actually receive in benefits. Yes, everyone's insurable, but every program so far has left out people disabled before the age of 18. And then when are they going to pay benefits? To anyone 18 and over or people 65 and over? That varies. But more importantly, this shifts responsibility to the state has me covered, which is going to disincentivize for people to buy more. In fact, that's exactly what we've seen in Washington. There is virtually no long-term care sales going on in Washington. I don't care who the company is. Everybody is reporting very, very, very minimal activity there. Now, this first started with the Class Act, which was actually repealed in 2013. It was part of the Affordable Care Act. It was a very poorly designed program, and so it was quickly repealed. But that gave states the idea, oh, well, maybe the federal government couldn't do it, but maybe we can do it. So Washington was the first state to pass a bill. Though the voters didn't want it, they were asked their opinion in a referendum vote if they would like such a program, and twice they voted it down. Nonetheless, they have it now. It's been delayed until July 1st of 2023 while they try to repair it because it was not very well planned out. And they have a payroll tax of 0.58%. For W-2 employees, they're going to exempt self-employed people. The tax can go up, benefits can go down, and even though there's supposed to be inflation, it's not guaranteed because whatever they have to do to keep the program financially sustainable is what they have to do. Now, if anybody still has any questions about the buyout, that ship has sailed. What's confusing people about Washington is they see this December 31st, 2022 date. That applies to applying for your exemption certificate. You had to have the policy by November 1st of last year. But if you have a policy that qualifies, you still have to apply for an exemption certificate from the EF until the end of this month now to get that certificate. You can have a policy, but if you don't have that certificate, you're not getting out of the tax. So what's next with Washington and other states? And why did I even talk about Washington? Why do we care? Because it's being used as a template. So it was a poorly designed bill that, as you're going to see, other states are also using as a template. So it's important to understand what went wrong, how it can be fixed, and more importantly, who do you know? What I have found over the years is advisors in general, they know a lot. You're successful because you know people, you go to events, you do charity work, and invariably, you know state representatives, or or your cousin works for the state representative or something. If you can help educate these people, it's going to make it a lot better as these bills start coming out. So this is why we talk about Washington, so you have a better foundation for having a discussion. Now, Washington just put out they had another meeting, and they're going to make some adjustments to the program. I got the document this morning. I was so swamped, I haven't even read it yet. I do kind of know what's going to be in it though. So one thing Washington recognized is they've got to put a recertification process in place. There were companies in Washington that were literally telling their employees, just get a policy, get anything, get your certificate, and then let the policy lapse. So they realize they've got to make sure that doesn't happen. Recertification is likely to happen. Another issue was low-income families. Their tax is not waived in Washington, and the cost of living in Washington is pretty high. As you're going to see, California does recognize that to be an issue. I don't know if other states will or not, and we're going to get into the other states shortly. So, and then there was a small group of us who had the opportunity to speak with the new director of the Washington Care Center. Delightful man. He's not a politician. He actually answers your questions just straight out. And I asked him, Why are the self-employed exempted? A lot of these people do very, very well financially and would be a great source of revenue, which your program clearly needs. So why would they be exempted? I didn't want to exempt them, but we didn't have a choice. Washington doesn't have a state tax, and we have no way to verify their income. And the federal government is not real cooperative in providing that information. Therefore, the only choice we had was to exempt them and then let them opt in if they would want to. I doubt very many people are doing that, but that was the only choice they had. The other big question we had in Washington, and again, it's important to know this when you see what other states are looking at right now. Why are they triggering a claim with 3 out of 10 ADLs and cognitive impairment is not treated separately? This made no sense to our group. And the director said, well, the goal of the Washington program was to create a bridge between the Washington Cares Fund and Medicaid. And they didn't want people to have a break in service. So if they use the Medicaid triggers, then they would already be pre-qualified. If their Washington Cares Fund money ran out, they could immediately move over to Medicaid if they were one of those people who would qualify. We pointed out to him that dementia patients may fail to qualify. 2 of us in this group had mothers that would not have met 3 out of 10 ADLs with their dementia. And we brought this up to him, and he did see that as a problem. I don't know if he's going to do anything about it. And those 10 ADLs are here at the bottom of the screen. As you can see, 5 of them are the HIPAA. There are 5 of the 6 HIPAA triggers. The other 5 are basically IDLs, and 1 is cognitive. So this is what everybody's been waiting for, the heat map. And by the way, you will get a takeaway from this meeting today. That it's a one-page, it's just a one-pager front and back short white paper, and it will have the heat map on that. You'll get that as a takeaway. We are not sending out the presentation for reasons things are changing so quickly. I have to control where the information is, so that's why I have the white paper out there for you. As you can see, the states to watch are California, New York, and Pennsylvania. And in fact, my heat map here is sort of like a traffic light. Green is go, so that's Washington. California is yellow. They're going to be the next to go. Now, interestingly, Pennsylvania and New York filed a bill. They proposed a bill. It didn't pass yet. I'll get to more of that in a minute. But California is really closer to enacting a program in all likelihood, and they are going about it the right way. They've already had 3 times the meetings Washington had prior to passing the bill, and they haven't even put it into the legislature yet. So they are, for the most part, doing it the right way. The rest of the states here, the ones in the black writing, are in alphabetical order, except I added Utah at the last minute and forgot to insert it in its alphabetical spot. So the states in the black letters are pretty much, they're just in alphabetical order. Now you see in orange, Pennsylvania, New York. I'm going to talk more about them in a moment. What I'm going to turn orange the next time, or I'm sorry, pink states. Let's go to the pink states, Minnesota, Michigan, and Illinois. Those states are moving slowly. They're moving very differently. Minnesota is the slowest moving state of all. They've actually been talking about something for 16 years. And they are debating between doing a tax or partnering with a life insurance company and offering what they call a life stages program. So we're not sure what direction they're going to go. We're one of the companies they're talking to, so that's why we kind of know where they're going with all of this. Illinois is the interesting one, and I'll get to them in a moment. And Oregon is going to be changed to pink in my next iteration, which I will also talk to you about in a moment. But first, I want to start with California. And the reason I want to start with California is if you do business in California, you should be talking to those clients now. So the task force is working on the plan very actively. And I'm going to go through some things that are probably a go, and then I'm going to show you this chart, which you'll see in a minute why how to put it into a chart. So what we know is the tax will likely be split between the employee and the employer. Now, in my opinion, that still means the employee's paying for it all in the long run, but that's how it's going to look like on paper. Interestingly, the self-employed will be included in the program. They will not be exempt. And of course, as we all know, California has a state tax, quite a hefty one, as a matter of fact. So self-employed people will have to pay the tax as well. The tax will be taken out of anyone who is 18 or older. So high school students working to save for college will not be affected by this. If you are a near retiree who can't vest for the 10-year required period, they are looking at pro rata benefits for near retirees. So if you only get in 3 years of work after the program is enacted, you'll still get a 30% benefit. If you're in there for 7 years, you'll get a 70% benefit, for example. With some of the options, which you're going to see on the chart, low-income individuals would have a premium waive, meaning they will be in the program, they'll get credit for the working year, but they won't have to pay the tax. And some of the options have a cap for high earners, such as something tied to Social Security amount. And in California, some of the programs offer rather rich benefits compared to other states. Fortunately, they're going to use the HIPAA triggers. So they're going to use what we're used to in the long-term care industry. They want to stay consistent with the industry. One of the reasons for the consistency is Washington did not want help from the LTC industry. They did it all by themselves, and that's why they're now having to fix it. California learned a lot from that. Their task force actually includes 2 distinguished long-term care actuaries. So these actuaries have had a huge influence on how this is constructed, and that's one of the reasons we're going to see them using the HIPAA triggers, which are consistent with the LTC industry. Now, all of the programs thus far in California is reimbursement to a state-certified caregiver, subject to limitations. So what this means is you can't just choose who or where you want to go for your care. You have to look at the California list and pick from that list, or the Washington list, or the New York list. All of them so far have direct reimbursement to a state-certified caregiver. They will allow family caregivers, but the family person, the family individual, is going to have to take a state course on caregiving, get a certificate, and then apply to the state as a state-certified caregiver for this to happen. California is considering 2 options to help people who have any type of long-term care coverage. The first would be a total opt-out. They wouldn't pay the tax, they wouldn't be in the program, as long as they owned some type of long-term care coverage prior to program enactment. Now, what that date is, we don't know. It could be the day the Assembly first signs the bill. It could be the date that the Senate signs on to the bill the Assembly already signed. It could be the date Governor Newsom signs the bill. We don't know. And that's why you need to talk to your clients now, not tomorrow, because the sooner you talk to your clients, then the more likely chance you're going to beat that enactment date, which is what you're going to have to do. Now, what California is doing compared to other states, are also considering a reduced they call it a contribution. Washington calls it a premium. It's a tax. Call it what you will, it's a tax. But California is considering a reduced contribution. Now, this is something, there's a lot of lobbying groups out there trying to educate folks. I'm on one of those committees, and we had suggested this to California, and part of our suggestion was 50%. They have not indicated what the percentage would be. We're hoping for 50%. And the idea is that if you miss the opt-out, even because you just didn't buy it in time, you're still going to have to be in the program. But what this reduced contribution would offer is that you would use your private policy first. The state benefits would be back-end coverage. The advantage is the person owning a private policy will have total control of their care with their private policy dollars. And the advantage to the state program is they're still going to get some revenue from that taxpayer, but the likelihood of having to pay those back-end benefits are pretty slim, because they will probably pass away before they use up their own private policy. So it's a win-win for both sides. Now, the goal to launch the program. Launch is not enactment. They're two different things. They're going to launch it, if all goes well, January 1st of 2025. So which means the enactment date is going to be before that date. So again, the sooner you get on out there talking to your client California constituents, the better. Now, this is the chart I was talking about. And they had narrowed it down to 6 options. And as you're going to see here, I have option 1, 2, 3, 5, and 6. So where is 4? Well, 4 and 5 were merged together. So I've left the numbering on purpose that way, just so you can kind of see where things are going. Anything in purple is the newest idea for that option. So option 1, for example, started out at $1,500 for 2 years. They're considering it, lowering it to $1,000. The benefits were a little more restrictive. They've increased what they would pay for a little bit, which is showing in the purple. So the purple is just things they've added to that option. Now, what's important to you? Go down to the bottom of the chart, the last 2 lines, opt out and reduce tax. Every program except option 1 would offer the opt out and the reduced tax, which means sales to you. The opt out is your first opportunity to get them out of the program. If they decline and say, oh, this thing will never go through anyway, I don't want to do it, and then they find, oh my gosh, it did go through, you've got a second chance through the reduced tax option. It's on all options except option 1, and it is highly believed option 1 is not what they're going to choose. And the reason is it just doesn't cover much. It's targeted mostly at home care. It would be targeted benefits such as paying an informal caregiver, meaning usually a family member. It would pay for home modifications, that type of thing. We're not talking about real care expenses other than helping support a family member who's had to reduce work hours or quit their job to take care of mom. Now let's go to option 6. That has a very rich benefit, $6,000 for 2 years. That's not going to happen either. The tax on that is going to be far more than, California's got gas prices that is approaching $7. They already have one of the highest state taxes in the nation. And this option 6 is going to be expensive. The legislators are very public about this. They're like, I am here to do things for my district. And if I can't get reelected, I can't be district, and this high is not going to get me reelected. Option 6, probably off the table. So what we're really looking at is option 2, 3, and 5. I'm not going to go through, you can see briefly here what they are. Option 2 is very rich in benefits, but it's got a 90-day elimination period, and there's also other things going on. But what's important is option 2, 3, and 5 all have the opt-out and reduced tax options. And that's what's important to you to be able to go to your clients today and say, let's get something done, let's do meaningful planning, and hopefully this is going to hold and you'll either get out of the tax or at least your tax will be reduced. So what's going on in New York? Well, they proposed a bill at the end of the 22 session. Now keep in mind, New York is only in session 6 months of the year, the first 6 months. The bill did not pass. They did not expect it. It was introduced in May and the session was ending in June. Why did they bother? The election cycle. So you're probably wondering, well, will they reintroduce it? Absolutely. Our lobbying group got to talk to the senator who proposed the bill. She is very passionate about getting this bill done. So yes, it will be reintroduced in 2023. It's almost a copy and paste of the Washington bill. And how do I know it's a copy and paste? Well, not only is it the same amount of benefit, direct reimbursement, 3 ADLs, the Medicaid triggers, but self-employed are exempt. Why? New York has a state tax. That's got to go from this bill. They don't need to exempt self-employed individuals. They just needed to get something out there, do it fast. Let's copy and paste Washington. They made one change, and that was to the tax exemption. It is open to a tax exemption. However, and this is important, the policy must be in effect by January 1st of the year the bill goes into effect. So meaning the previous year. Now, currently in New York, only traditional LTC policies qualify. Our lobbying groups, there's several of them out there working to expand the product exemption. The reason for New York has a very narrow definition of long-term care. They do not even if it is federally recognized as a long-term care policy because it's 7702B, New York does not consider it long-term care if benefits are paid as an acceleration of death benefit. So that's a problem because that's how the majority sold in New York are. Now, the irony is we're finding out the legislators don't even know there's other options out there. They think traditional policies is all there is. So we're educating them and hoping to get them to expand product exemptions. Now, if I were to bet, will they expand? My bet would be if they expand, the number one chance of an expansion is going to be a linked benefit policy versus a long-term care rider on life insurance. And here's why. The long-term care on life insurance, is supposed to be sold as life insurance first. But linked benefit policies, even though they're on a life insurance chassis to protect the premium, they are a long-term care sale. You do not buy linked benefit policies if you need life insurance. So we are really hoping we can at least get them to accept a linked benefit policy. No guarantees, but if your client is not interested in a traditional policy, your next choice should be a linked benefit policy to have a shot at the exemption. Now for Pennsylvania, this was the second time they put a bill out there. They put one out in 2019 for the election cycle. They did it again this year for the election cycle. We're not sure how serious they are. We know they're more serious than they were the first time because the Washington bill actually got passed. But they are a true copy and paste of Washington, even down to the amount the tax is going to be. They're using the older benefit unit language. They're using the older vesting language that Washington has changed. And they're also exempting self-employed people. Again, why? They have a state tax. There's no need to do that. Now, they will offer an exemption. They have given no details. We have no idea when you have to own your policy by. We're assuming, Pennsylvania recognizes 7702B products as long-term care, so it should be safe, just like California, to sell anything that's 7702B, even if it's a rider or a linked benefit policy. So what are other states doing? Well, don't worry, I'm not going to go through each one of these states. I am going to pull out just two. Illinois, they want to create basically a social health care system, a single payer system in Illinois. Now, California tried to do that a few years ago and they couldn't get it through. Illinois is on hold right now, but what they would like to do is create what's called a Health Care for All Act. It would include long-term care. And here's how it impacts you. If they pass this act, they will also pass an act that would outlaw selling any type of health insurance covered by the act. So what does that mean? It means that you would not be able to sell long-term care insurance in Illinois. Now, they can't stop people from buying it if they have nexus in another state. If they have a condo in Florida and buy a policy in Florida, nobody can stop them. But as far as having business in Illinois, that would be over. Oregon is starting to look at the same thing. They're also looking to do a single payer healthcare system. Now, in Oregon, they have decided they're going off of that for now. So that's an update from what you see on the Oregon line. They've already made the recommendations now. So what they want to do is do a single payer system, but not include long-term care yet. And the reason for they haven't figured out how to make sure that anyone already receiving services wouldn't get a break in service while they were transitioned to the new program. So it's a yet. Now, it didn't say anything about outlawing the sale of other products, but that could easily come with a single payer system. So again, if you have clients in Illinois and Oregon, now would be better than later to start talking to them about long-term care. Now, we want to avoid the Washington effect, whether for your clients or for the insurance carriers. So for your clients, as I said earlier, Washington, the sales in Washington are minuscule now. Basically, the constituents who didn't already get a policy, now the rest of them are like, well, I guess I'm going to be on the state program. The citizens have been disincentivized from purchasing meaningful coverage. In fact, the state has already figured that out. There's a new report that came out this morning. I have not had time to read it, but I know what's in it already. And one of the things is Washington is recognizing that maybe they need to partner with the long-term care industry because what they really have is a short-term care program, not a long-term care program. And they're realizing that nobody's buying insurance now, and that's a bad thing. And your clients, I mean, let's face it, how much is $36,500 going to buy? Even if there's inflation, which isn't guaranteed, it's going to, the inflated amount will buy exactly what $36,500 buys today. I was talking to an advisor a couple of weeks ago who has his mom in a memory care unit. He's spending $15,000 a month on a memory care unit. He just laughed at this program. He says, that's not even 2.5 months of my bills for my mother. That's not long-term care. That's not even short-term care. Your clients are going to want to go to better places. They're not going to want to go to the cheap places. They're going to want better care, more expensive care, the higher end care. These type of plans are not going to help your clients. Unfortunately, the bad press, Washington had to justify why they did this after 2 referendums said, no, we don't want it. So they basically put out a ton of erroneous information about the long-term care industry to justify why they were doing it. Unfortunately, that erroneous information was picked up by other states like New York, who now believes that to be true. So that's one of the things we're doing right now is our lobbying groups are trying to show these people this information is not accurate. Here's the real information. We've got data, I mean, real data, not just rumors. And then the poorly timed Washington buyout created havoc for the industry. As you remember, carriers were just inundated, they were just totally swamped with applications, which created a lot of problems. And we have that same concern that another tsunami is going to happen. Carriers are watching this like a hawk. That's important for you to know. If you want to choose the company, which I hope will be nationwide, but if you want to use the company of choice, the product of choice, and the amount of coverage of choice, now is the time to talk to your clients, because these choices are going to start shutting down as these bills start ramping up. Some people will benefit from state bills. I mean, it's not a horrible thing, but it's going to be lower income people who kind of miss out on the Medicaid qualification. Uninsurable people, something is better than nothing, though some of these people may end up paying more in tax than the benefits they receive. And anybody retiring in the next 10 to 15 years, at least it may not be much of a coverage, but they won't have paid more into it than they'll receive. But if they're still insurable, they should think about long-term care coverage. And people are going to get left out of the benefits. People who are already retired are getting nothing. Now, some of the states talked about doing a voluntary tax program. This is where the retiree who is already retired, they would take their last 10 years of income, average it together, come up with a tax, they would pay it for 10 years and be in the program. The problem is it would cost the entire program quite a bit more money because there would be so much adverse selection with all of the retired population. So that's probably not going to happen. Non-working spouses are not covered. If your spouse stopped working when they had children and doesn't plan to go back to work, they're not covered. They still need to buy something. And people who move out of the state. Washington's bill has not been portable. They are talking about it. California does have portability. We don't know whether these other states are going to have portability or not. So private coverage gets you portability. I'm not going to go into all of the federal bills, but I wanted to go over two things. The WISH Act. This is something that is going to really expand. It would be a federal bill. It looks a lot like a state mandated program. It would be federal and there would be no opt out with it. A thing to watch here though is I don't think it's going to pass, but if it did, and this is important, the elimination period on that bill is 1 to 5 years and it's means tested by income. That means your clients are likely to be in the 3, 4, and 5 year elimination period. They would die. They might die before they get a dime of benefits, or may only get benefits for, a little bit of time before they pass away. So it's important for them to have private coverage that they'll have available immediately. And then the other thing I wanted to talk about, the Long-Term Care Affordability Act. This was the act that we had all been lobbying for years. And Senator Pat Toomey said, okay, we'll do it. But that sizzle is turned to fizzle, and here's why. And I'm going over this because there was a lot of news in the trade magazines recently. And some of those articles were not accurate. So the original bill that Senator Toomey proposed is that you would have been allowed to use qualified money to buy traditional long-term care insurance, riders on life insurance and annuities, or linked benefit policies. It would have allowed up to $2,500 a year, and that number would go up each year, and you would not have to pay tax on that money, nor would you be subject to the pre-59.5 penalty. Senator Toomey is retiring at the end of this year, so he wanted to make sure that bill didn't die. And the reason is that bill would have a huge impact on promoting the purchase of private LTC coverage. And private LTC coverage is what keeps the LTC industry, care industry, healthy. Too much Medicaid drives down the quality of care because Medicaid reimbursements often do not even cover the cost of care. The private pay patients are who keep the nursing homes in business. We need private coverage, and we need a healthy private pay and constituency. Unfortunately, while they agreed, the folks who were putting together the Secure Act 2.0 and the EARN Act agreed to put it into the legislation, they refused to make it tax-free. So it's in there, but now the $2,500 a year is going to be taxed. The only thing they won't do is make you subject to the pre-59.5 penalty. So basically, the sizzle is now fizzle. I don't think this is going to, we've lost 98% of the impact this would have had. I mean, to me, all this is going to do is allow people with 403Bs, which usually have it's pretty hard to get money out of your 403B. And they may be able to get money to buy insurance or your 401, whatever, but no one's going to want to pay the tax. So I think this is going to be a huge failure, and that's just a huge shame. But I just want you to know, and if you've heard rumors that this is going to allow a tax-free distribution, it will not. So why do we want to discuss long-term care with our clients today? Well, 30% of states are discussing something. Something is different among different states, but they're discussing something. And the opt-out, no one's going to have a buyout period. No one's ever going to do what Washington did again. Washington passed a bill and then gave everybody 6 months to go buy insurance. And they expected 100,000 people to opt out. 500,000 people opted out. And that's just in a population of 7.5 million people. So no one's ever going to have a buyout period again. They're just going to have an opt-out that you have to have that policy before whatever the enactment date is. You got to avoid the rush, or you can lose opportunities to purchase. In Washington, some companies bailed out from the beginning. I mean, you all out there know of companies you could not sell in Washington until that whole thing was over. They just pulled out. Other companies, like one of the traditional policy companies, they were getting slammed with $25 a day applications. So they took $25, $50, and $75 a day applications off the table. You had to buy $100 a day. These are the type of things that are going to happen. Companies are going to pull out, or they're going to put restrictions. Maybe a life insurance company will no longer sell $100,000 policies with LTC writers. They might require you to buy at least $250,000. So they're going to control the people who are going to try to buy the cheapest thing possible just to get out of the tax. Insurance companies, they've got to do this for a lot of reasons. It isn't going to help if they can't process the applications. So, I mean, watch for that to happen this time. We all know that price goes up with age, and health does not improve with time. So it's always better to buy today than tomorrow. Non-working spouses, again, are not likely to be covered. And what you want is the time to have a realistic conversation with your client, not just a desperate to get something for tax avoidance conversation. Opting out is clearly a choice. And there were people who decided they just wanted to be in the program, even though they could afford coverage. High earners, they're going to pay more in taxes than they'll ever receive in benefits. They're obviously a good source for people who want to opt out. People who want more control of their care choices. They're going to have limitations with the state-approved services. And young up-and-comers with growing salaries, they're going to pay taxes for decades. They could be like high earners, just paying way more into the program than they'll ever receive. And we don't know which states are going to have portability and which aren't. Maybe we should just take that worry off the table and buy coverage we know will be portable. Why is private insurance better? Well, because the state programs are one size fit all, and we want to be able to customize. And if anybody picks up on this means testing, elimination periods, your high-end individuals would receive the least, if any, benefits. So they really do need their own private coverage. State programs are subject to tax increases or lowering of benefits or even limiting of services, where with private coverage, you're going to be guaranteed your premiums and your benefits. You'll get flexible premium trade, pay it up the way you want to with private insurance. And if you're interested in inflation, it's guaranteed. The Washington inflation is not guaranteed, nor is New York, nor is Pennsylvania, and only one of California's options is guaranteed, and it's the option that's not going to happen. It's number 6. So if you want inflation, the only way to get a guaranteed amount is through private coverage. You get better coverage. You're going to get better leverage with private coverage. Your premium will be protected. One of the things that people kept throwing out with these state programs, including California, is, well, let's allow people who don't use their benefits to leave it to their loved ones, or at least give them back the tax they paid. Again, it costs too much money in the tax. They're not going to do it. So if you have private protection, you can protect your premium if you don't use the policy. Again, the portability, you want guaranteed portability, that's private coverage. And with private coverage, you can pair solutions with other financial strategies. So for example, you have a 45-year-old who just got a big promotion, just bought a bigger house, bought a bigger boat, is saving for kids to go to college. He needs more life insurance. We can kill 2 birds with 1 stone by having the, having his life insurance policy. Hang on, folks. Brittany, I think my power's, I got to grab my cord.
Okay.
I'm so sorry.
No worries. Well, while Sean gets her power back up and running here, we'll go ahead and answer a few questions that have come in that at least I can tackle. So we had some folks asking if life insurance will count towards some of these opt-outs. And that's where you're going to have to really look at the language of the bill. So fortunately enough, in the state of Washington, it was policies with a 7702B rider being available. So that opened it up to standalone long-term care, hybrid long-term care life and annuity policies, and also your more traditional life insurance with accelerated LTC riders. So you've got to be careful on the IRS code. 101Gs did not count towards the opt-out, including short-term care insurance. Even though short-term care insurance looked similar to the Washington state benefits, it was not allowed as an opt-out provision. And as Sean mentioned earlier, New York, as it's currently written, is only on those traditional standalone products, and hopefully we can all lobby together and get that ruling changed. So really, when these states start passing these bills and making this into laws, of course we'll keep you all informed, but let's just make sure we're looking at the bill language and recommending the correct style of products.
Correct. And I'm back. I got unplugged. You can see the screen is brighter again. Yeah, when the screen fades, I know I'm about to lose it. So that I forgot to plug in this morning. But yeah, Brittany is right. You're going to have to read the bills right now. The 3 states, the California, of the 3 states, California and Pennsylvania should be following the Washington definition. 7702B will be safe. Chronic illness riders, no. New York is the odd man out. So, but you've got to check every one of these states as they come up. And as Brittany says, we are all as an industry going to keep you informed of that. Okay, perfect. So we'll keep going here. You're going to get better coverage with long-term care. And as I said, you got that 45-year-old. We can give him the life insurance he needs now. His life insurance, it's some point, the house, the kids going to college, and etc. They're going to be out of college, out of the basement. He's going to be retired, and hopefully his house is paid off. He doesn't need the life insurance anymore, but he now has long-term care coverage with that same policy. You can't do that type of financial strategy with these state programs. So this is why private coverage can help you in planning. And then at claim time, we're going to be using the HIPAA triggers. There's no confusion. You get your choice of care providers. You can choose the benefit model you want that makes more sense to you. And you don't have to worry about family. In Washington, there's a big fear that these family caregivers who get approved and on the state list are going to have to join the caregivers union. You don't have to worry about that when you have private coverage. But the number one reason for private coverage is it increases your marketability as a patient. I have 3 policies. That's why I have 3 policies. And the example I give, there's a very nice place you want to put your mother, and 3 people, there's 1 bed left in that facility. 3 people have applied for it. 1 person has been pre-qualified for Medicaid. 1 person has $5 million in assets, and the other person has $1.5 million in assets and a long-term care policy. Who gets the bed? The person with the policy. They don't want the Medicaid patient. They're going to get 2/3 of the billable rate from Medicaid. They don't want that. The person with $5 million, yeah, they can pay the billable rate. The problem is if they've got greedy children with power of attorney, those greedy children could start hiding the money and try to put them on Medicaid. They don't want that hassle either. But the person with a policy, the policy can't be messed with. They're going to get paid their billed rate. So they want the person with the policy more than they want the other 2 people. Long-term care insurance increases your marketability as a patient. If I ever have to go to a facility, I got 3 policies to show them. So I think I'm going to be number 1 on the list. And I hope your clients will also want to be number 1 on the list. And we've talked about writing good business. We don't want to be about tax avoidance. But in Washington, and this is important, in Washington, they didn't have a minimum coverage. I got that question right up to the last day you could sell the policies. I don't know if other states are going to go that direction. And I have to wonder about New York in the long run. And what I'm telling people, if we don't know, we're trying to sell to our clients now to be responsible, but we don't know if a state minimum will come into play. So my recommendation, since we don't know what to do, is to sell, if you're selling a traditional policy, which we do not have at Nationwide, but if your client is interested in that, sell them no less than $100 a day. If you're going to use a linked benefit policy or a long-term care rider on life insurance, make sure the benefit is at least $3,100 a month. So why not $3,000? Well, I'm using the New York rule. The New York rule with linked benefit policies is you have to have $3,100 a month because they have a $100 a day requirement, and $3,000 a month is $97 a day when you consider there's 365 or 366 days of the year. So sell $3,100 a month if your client can afford it. Worst case scenario, the law changes, maybe you'll have enough time to buy another policy and get it, but I can't imagine they're going to go above $3,100 a month as a minimum, because a lot of these programs, that's all they're paying, and they're only paying it for a year. So there would be no reason for them to require more than that. $3,100 is I think a pretty good guess. Nothing's guaranteed, but that's my recommendation. I'm going to leave this screen up for a moment. Again, you're not going to get a copy of this presentation, but you can get our calculator by holding your phone up to that QR code. Use the Apple one if you have an iPhone, or you can use Google Play Store. You have to put in a code once and only once. It's NWLTC. So think of it as Nationwide Long-Term Care, NWLTC. What you will get is this calculator. You can either hold up your iPad or hold up your phone, and you'll get this quick calculator that includes historical inflation and will allow you to find out what the cost of care in any of the major metropolitan areas in the country. I mean, there's regional and major metro areas. So this covers a whole mean, basically any place your client lives in a state is going to be in this calculator. In the informal care category, what that is the average loss of income an informal caregiver might have if they were caring for you a good deal of the time. So anyway, this will give you an idea of what to plan for. I always say, you know, plan for the shortfall, not the, you don't need to plan for the entire cost of care for a lot of people. Some of it's just a matter of the shortfall. And with Nationwide, we have Care Matters, and we've got an electronic process, Part 2 digital application. Only the cognitive test is done by phone now, and if you're under 60, you don't have to have that either. The California only medical concerns will trigger an APS because California does not allow us to ask as many questions. They consider it a HIPAA violation, so you will find more APSs triggered in California than other states. Our LTC writer has a digital Part B application, electronic processing. It's fully underwritten, so you will still see an APS. And we have cash indemnity benefits, which allows for the most choice of care, regardless of which product you choose with us. So the message here is Washington has a population of about 7.5 million people, and they shut down the entire long-term care industry. So just imagine what California could do. You got to talk to your clients now. Let them know the importance of having a good long-term care strategy. Let them know the options that are available to them now that may not be available to them in a year from now if the tsunami starts to hit. So you want to make sure they can get the best coverage available that works out for them, whether there's a tax opt-out or not. So Brittany, we'll go ahead, and if you've got some more questions, let's go.
Yes. So first, Sean, can you do me a favor? Go back to your slide with the cost of care QR code and link. We had a few people miss out on that.
Okay, there you go.
Woo! All right, thank you. And we do want to be respectful of your time. We had a good amount of questions coming in, so if we don't address them right now, I'm going to be reaching out to you personally today to get your questions answered. But Sean, there is one that I came across I would like to get your thoughts on.
Okay.
We had a question come through, and you might not have an answer or not, but is there a reason why states might not be looking to mandate that long-term care be included as a company's benefits and let the private sector handle versus the government providing these state programs? Any thoughts there?
Well, that's kind of some of the discussions we're trying to have with states. We're trying to find answers. As you saw in my original slide at the beginning of the program, the private industry can't do it alone, and the public industry can't do it alone. We've got to put our heads together and come up with options. And that is one option, is that long-term care benefits would at least be offered. Most companies, and a lot of your clients, if you ask them if they have maybe it's a new client, you ask them, do you have long-term care coverage? They go, oh yes, I get it through my company. 90% chance, if not higher. They don't have long-term care. They have long-term disability. They think they have long-term care. They see the words long-term and care immediately goes into their head, and they think that's what it is, and it isn't at all. So first, I would say, let's look at your benefit package to make sure what it is you have. I know one of my policies I did buy through my company. They don't offer it every year though. And I think that's a phenomenal idea, whoever asked the question, but at least, maybe not forcing people to buy it through their company, but forcing companies to offer it would be one way to get people to buy it if they could, with the group and guaranteed insurability, at least for the employee. And that's those are ideas that we need to talk to the states about. But that's exactly what that early slide was kind of about. How do we put our two heads together? And that's one fabulous idea.
Perfect. I appreciate it, Sean. And again, trying to be respectful of time, but very briefly, we covered high level of the nationwide long-term care offerings. Just to let you know, there's a variety of ways you can fund that policy, especially on the Care Matters side of things. We've got single premium, 5 pay, 10 pay, pay to age 65, pay to age 100. They can be monthly, quarterly, semi-annual, and annual premiums. So there's flexibility there, not only with nationwide, but with our other solutions I have on the desk.
Yeah,
So
and with
I do see.
nationwide, Brittany, keep in mind with nationwide Care Matters, we do annual and monthly only. The rider, you can do all four. With Care Matters, it's monthly and annual, but the good news is there's no modal factor with Care Matters. So if you want to pay monthly, you'll get the exact same benefit you would get with an annual payment.
Yes, so just divide that annual premium by 12 and you're going to get that premium. So pretty slick not having those modal factors.
Right.
All right, well, I show we've gone a minute over time. So again, want to consider all of your days. So thank you for joining us on this session today. Again, those questions I didn't get answered, I will be reaching out to you individually today. Sean, of course, thank you for taking time out to address this important topic with us. So if you think of any other questions or would like to discuss more, feel free to give our team a call. We're here at 800-228-0008 or shoot us a quick email at ltci@jetter.com. So I will let everybody get going. Again, thank you so much for joining us and look forward to speaking with you all soon. Thank you.
Thank you. Bye-bye.